Hi guys, I hope everyone is safe during the pandemic. As for me, well, today was a bit cloudy and windy, so it was a perfect day to stay in and read. So I've been reading through the first chapter of the Technical Analysis of the Financial Markets by John J. Murphy, and although it did not introduce any strategies, his first chapter had some interesting selling points on technical analysis that I thought shouldn't be skipped. So I made a video analyzing those topics. The first topic that's brought up is what are the underlying rules of technical analysis and why in the world would we use technical analysis out of the numerous different trading strategies that exist today? So there are three rules of technical analysis that is brought up in chapter 1. The first rule is that price action discounts everything. So what in the world does this even mean? It may sound complicated, but it's actually really easy. Basically, the current stock price is priced in a certain way because whether it be the stock's underlying fundamentals, or news surrounding the stock, or any other price moving factors, it is already priced in into the stock's current price. Since everything is already priced in, market price should be the only thing studied. You don't need to know why in the world the stock is up or down because knowing why a stock is up or down is not necessary because the why is already priced in. Therefore, everything is ultimately reflected in the market price and you should not be wasting your time on anything else as everything else is already priced in. The second rule is that price moves in trends. To even use technical analysis, you need to accept the fact that market trends exist and trends are more often than not followed. Trends are only broken when stocks show signs of reversal, and this is the most fundamental rule of technical analysis as technical analysis centers around following trends. The final rule of technical analysis is that history repeats itself. As technical analysis itself is based on analyzing patterns of charts over hundreds of years, not accepting this rule would mean that technical analysis does not work and you should not even consider this as a trading strategy. From here, the topic on why you should use technical analysis when there are so many different trading strategies is brought up. First, when compared to studying fundamentals, which is another famous trading strategy, even the likes of Warren Buffett uses it, he argues that technical analysis is far more superior. So what are fundamentals? People who study fundamentals are called fundamentalists, and they study the cause of market movement. Basically, a fundamentalist would want to know why a stock went up or down. Was it due to their good balance sheet? Does the company have low debt? Or maybe the company has high cash flow? Technical analysts, on the other hand, want to study the effect of market movement. Basically, a technical analyst would want to know how the stock moving up or down would affect future price movements. Therefore, technical analysis is usually the way to go because it tries to predict the future as it only studies price action. More importantly, however, when there is a trend reversal, fundamentals and technical analysis contradict one another. So why does this happen? He argues that this happens because technical analysis studies price action only, and it is known that price action is a leading indicator of fundamentals. Eventually, fundamentals will catch up and correlate with technical analysis, but at that point, it is usually too late to buy as the price movement has already finished. Next, he argues that technical analysis is a superior trading strategy because it can be applied in many ways. For instance, swing traders can apply technical analysis on the hourly chart. Not only that, but technical analysis can be applied to even longer time frames, such as yearly charts, helping long-term investors enter and exit long-term trades. Not only can it be applied to charts of various time lengths, but it can be also applied to different mediums. By mediums, I mean technical analysis can be applied to futures or the stock market. Although there may be some differences that will be discussed in later videos, the fundamental application of technical analysis is the same. Furthermore, you can do technical analysis on a variety of sectors, whether it be tech or commodities. Most of the time, he argues that investors will need to specialize within a certain sector, but with the adaptability of technical analysis, he argues that there is no need to specialize. This is particularly useful when different sectors do not have clear defined buy or sell signals. If a certain sector doesn't have strong signals, then you can simply move into a different sector with a strong and well-defined buy or sell signal and play more safely. However, with technical analysis being so popular, there are many critics that argue against it. The remaining portions of this video will refute major arguments against technical analysis. The most popular argument is that all of technical analysis is just one big self-fulfilling prophecy. Basically, technical analysis is so well understood and used that when a certain pattern or signal comes up, it causes people to buy and sell accordingly. This in turn allows the intended response to come to life. However, this is wrong because he argues that technical analysis is very subjective. For instance, a strong signal to one person can be a moderate signal to another person. This means that some people would buy or sell while others may look for more signals to help them decide. Hypothetically, even if the signal is a clear buy or sell, people will not buy at the same time. For instance, there will be people who would wait for a retest, then buy or sell, while others bought or sold at the start of the signal. Furthermore, even if they did buy and sell at the same time, he argues that technical analysts on their own do not have enough money to pump or dump the stock. He then brings up an interesting comment that I found very convincing. He states that in the end, even if this whole thing is a self-fulfilling prophecy, why would you not use it? If a certain signal causes a certain result, why wouldn't you move appropriately and profit off that certainty? Another argument that critics bring up is whether or not history repeats itself. Of course, we do not know if history repeating itself can be applied to everyday life, but within the stock market, statistics prove that there is a correlation in previous and present patterns. Since there is a correlation between patterns, technical analysis was made so that we can predict or guess at what is most likely going to happen in the future. This is extremely useful as technical analysis is one of the few trading strategies that truly helps investors decipher future movements. The final argument that critics bring up against technical analysis is the random walk theory. The random walk theory states that price action is entirely random and is therefore independent of past events. Once again, this is wrong because if price action was truly random, there would be no bull or bear markets. This is because a stock could not possibly go up or down for an extended period of time if it was truly random. Furthermore, in life in general, he argues that many things are categorized as random and is due to patterns or explanations not fully being discovered. For instance, a novice technical analyst will see that the market does have a lot of random movements, but as a person gets trained, many of those random movements are explained by patterns that were not previously known. Finally, if the stock market was truly random, technical analysis would not even be a popular trading strategy. Frankly, a trading strategy can only be popular if it makes money. Since technical analysis is a trading strategy that is fundamentally based on finding patterns and trends, the stock market can't be truly random. Well, thanks for making it this far. I hope that you learned from this video as much as I did from reading the book, as that is the whole point of this channel. So far, the book tries to sell technical analysis as a good trading strategy, which was helpful as it helps confirm the validity of technical analysis, and I'm not wasting my time reading this 500-page book. I'm eager to discover the different trading strategies that will be introduced in later chapters, as it looks like chapter 2 is when the actual material starts. Subscribe so you don't miss the next video, and like and comment on the video as it really supports the channel. I'll see you guys next Wednesday at 3 p.m. Central Time. Thanks.